Welcome to LevFin Insights podcast series, Levered Lines. I'm Luke Miller, Global Editor-in-Chief at LevFin Insights. I invite you to listen to our series of podcasts where we interview key market participants as we look across the main themes impacting the leveraged finance markets. And with that, over to the team.
Hi, I'm Krista Giovacco, a senior reporter at LevFin Insights in New York, where I cover private credit. I'm joined today by Brian Garfield and Lucas Weiss of Lincoln International. Thanks, guys, for taking the time this afternoon to speak with me. Would you like to kick it off, Brian, and just introduce yourself and tell us a little bit about what you do at Lincoln International?
Yeah, great. We're excited to be here. Really appreciate the opportunity and happy to do that. So just by way of background, Brian Garfield and I head up Lincoln's U.S. portfolio valuation practice. For those that are less familiar, Lincoln International is a leading investment banking and advisory firm serving the private capital markets. And the group that Lucas and I sit in, which is the valuation and opinions practice at Lincoln, performs over 7,000 portfolio company valuations across the private capital markets on a quarterly basis. In fact, we are seeing even more valuations that are being done more frequently than quarterly. And for a lot of what we're doing, we are collecting data and information about the private capital markets, which we're thrilled to talk about today. We work with over 200 different alternative asset managers, and so we have a really good array of stats and information that we're looking forward to sharing. Lucas, you want to introduce yourself?
Yeah, my name's Lucas Weiss. I'm a managing director in the Portfolio Valuations Opinions Group here at Lincoln as well. I'm out of our Chicago office, having joined back in 2014, same year that Brian did, coincidentally.
Fantastic. Well, again, thank you both for being here with me today. There is a lot going on right now in the news, and private credit seems to be capturing much of the attention. As we start 2026, can you just tell me what the key deal-making dynamics are that you're seeing right now?
Yeah, I'm happy to start. And Lucas, feel free to chime in. Lucas and I always chat about the market, so this is just going to be like a normal water cooler chat for us. So in terms of what we're really seeing, it's really robust. The private capital markets are robust right now. As we think about where we ended last year, we saw a tremendous amount of influx of volume taking fold across the markets, particularly the sponsor-backed community, where we saw a return of deal volume relative to what it was prior year in 24. And so it exceeded those levels, which is really quite exciting. That being said, the deal count was a bit slower relative to what it had been historically, but the number of billion-dollar plus transactions that Lincoln was seeing and really just across the marketplace flourished. And so we're really seeing those dynamics kind of take fold as we move into 2026. And one of the things that we talked a lot about in 2025 was A+ quality deals getting done, and how it had to be A+ quality to get done. And Lucas, why don't you comment a little bit about the dynamics relative to the quality of deals we're seeing getting done today?
Yeah, thanks, Brian. I think we started the year with a little bit less volume than perhaps anticipated in 2025. And so there wasn't this tsunami of deals over the course, but rather a steady increase of deal flow throughout the year. And that came from a little bit of the widening of the gates as more deals were able to come to market. And so it was, a really limited focused on A-tier quality deals, I think has expanded a little bit, especially as we went through year end. And market participants really looked to deploy capital, both lenders and sponsors. And that became very important as we looked to close out last year. And so, maybe bridging ahead to next year a little bit, I don't know if we're going to see that tsunami again, but I think we might see this trend continue as we look for more deals to come to market over the course of the coming year.
Sure. Just to be clear, though, I feel like a lot of the deals last year really were refinancings and dividend recaps and add-on transactions. This year where everybody's expecting there's going to be a pickup in M&A. And of course, we've seen that movie before, but what are you expecting on the M&A front?
Yeah, I think that, we are going to see, and we're starting to see, pick up in the M&A activity relative to what it was at its low point. I think what's really exciting from the data that we're observing as well is that when deals are being brought to market, they're commanding very healthy multiples. In fact, when you look at the data in 2025, the observed transaction multiple for deals that were getting done actually exceeded those in those levels from 2021 when it was the peak in the market. So I think that's really exciting just to see that when the deals are being brought to market, going back to the quality of that deal, we're seeing that deal has a higher commanded multiple, which is great. But to the same point, I do think that we are starting to see that volume pick up, and we saw that evidenced vis-a-vis the percentage of deals that were $1 billion or more, really starting to overtake the market fold. We would agree that there was certainly an influx of refinancings that took place, really part and parcel with the fact that we're seeing spread tightening occur throughout all of 2025. And so there was an opportunity to really refinance a deal at a more favorable cost of capital for the underlying portfolio companies. And it's very well possible that there are some other deals that will still be refinanced as we move into 2026. But overall, I would say, I am bullish on the M&A outlook, and to agree with Lucas generally that it's not going to be a tsunami, but it's going to be kind of a steady Eddie, go to market with the businesses that could command valuation levels that would lead to less of a gap between a buyer and a seller.
I think what I might add to that is that there were a number of deals last year that wanted to go to market and for various reasons couldn't, whether that was volatility as a result of Liberation Day or, further uncertainty from various administrative changes in the healthcare space or the education market. And so there are a lot of idiosyncratic issues that kind of popped up that led to a lot of the refinancing and amend and extends that you're referencing that allowed sponsors to either address certain issues, adapt to a different market, or further grow the business that I would hope leads to some additional successful exits in this coming year. I think the other aspect of that is that, and Brian touched on this, the higher multiples that we've seen for closed deals increased steadily throughout the year. So that wasn't just a one or two, high multiple outlier, but we saw higher multiples for closed deals continue to improve. And I think optimistically would hope that as we head to next year, some of that uncertainty further dissipates and might continue to stay elevated or further increase.
Yeah, one thing also that comes to mind that worth sharing on this topic too is just the fundamental performance that we're seeing. So private capital markets really are driven off of fundamental performance of portfolio companies. And when we think about the percentage of growers that we're seeing across our proprietary database, we're seeing that the percentage of growers on a revenue and EBITDA basis continue to remain robust. And so the fact of the matter is that we're seeing over half of portfolio companies growing on an EBITDA basis. I view that as a very positive thing. When you look at the magnitude of growth, we're still seeing positive growth on a magnitude basis. There is an element that the growth on average is slowing, but when you look, so it's going down from, let's say, 5% or so to something slightly less than that. That all being said, it's still positive growth. And I think that speaks volumes to kind of just the health of the market. And so, for those reasons, I think we're in a good place when it comes to the overall, quality of the private markets today.
Sure. And I guess against that backdrop that you present and saying that it's really strong and EBITDA is growing, I would imagine then that company management teams are looking toward 2026 with optimism. Would you agree with that?
Yeah, I think we definitely would. I think they enter every year with a strong degree of optimism.
Mhm.
As part of their valuation processes, we get access to the budgets that all of these companies prepare. And on average, they project about 8 to 10% growth at the beginning of every year. On average, they come in maybe marginally below that, but still with really good results for every year. From what we've seen, early signs are indicating that it's kind of the same headed into this year. I think it also reflects what I touched on earlier around some of the uncertainty from the last year has started to dissipate. There's now greater insight into the tariff environment. There's greater insight into some of the healthcare regulations that might be passed. So, and industry by industry, they each have their own nuances, but I think there's a little bit less uncertainty, or I should say that uncertainty that popped up during the middle of last year has started to fade away a little bit. I think that allows management teams to kind of retain the optimism that they see at the start of every year.
Great. And last year, I would say it was more of a borrower sponsor friendly market. Is that expected to shift in favor of lenders this year as rates stabilize and maybe the macro picture becomes more certain?
And I think there's a very real possibility that it might stay quite borrower friendly. Part of the reason it was so borrower friendly was this really large supply of capital in the private credit markets. Um, Private lenders have been very successful in fundraising and have had to look to deploy that capital. That pressure still remains. There's still a ton of dry powder from private lenders that will need to be deployed. And that's driven a lot of competition amongst lenders, which has driven a lot of the borrower-friendly terms that you're referencing. So it's very possible that we could see that continue. Now, at the same time, should uh, further headwinds arise due to unexpected tariff changes or further uncertainty crop up over the course of the year, like we saw during the middle of last year, it's very possible that that pendulum swings the other way. I think the other elephant in the room, certainly in the software segment, is AI and how that might change some of the underwriting dynamics for lenders. They're certainly all looking to leverage AI throughout their processes, but does that mean they might look to lend differently to software companies? It's something that I think everyone will have their eye on over the course of the next year.
So for sure.
Yeah, and I think one of the things with AI and software that I think is noteworthy is that while it is newer, it is not new. And so as we think about and we speak with our uh, clients and just as we talk to market participants about what they're seeing as AI, it's an underwriting consideration. I mean, these are things that are being evaluated when the deals are being done. I think the market is, in terms of underwriting those deals, it's evident that they're a part of a lot of these underwriting theses, and so I think that it's just something that we should continue to keep an eye on, but something that not so sure that that will necessarily be the full shift over, but yeah.
Well, I think you're not the only one keeping an eye on AI software technology right now. um,
One of the trends we saw really through 2024 and especially the first half of last year was lenders being pretty conservative on how deep they would go into the capital structure. So although leverage might have increased because we saw multiples increase as well, the average LTV for closed deals was only about 40%. So I
okay.
think one other aspect that might swing that pendulum back further to the lenders would be a willingness to lend deeper into the capital structure, which would garner them higher yields and higher spreads. So that's another tool in their war chest to kind of help bring that power back to the lenders.
Well, that sets me up perfectly for my next question because we published Lincoln's pricing data in a snapshot bi-monthly on LFI. And we've seen like pricing has stabilized in the senior debt, but we're just kind of wondering what is the demand in junior and sub debt looking like?
Yeah, I think one of the things that has kind of transpired over the course of the year, and then we can comment specifically on the sub debt category, is there was two elements to this. Have been tightening over the course of the year, coming off of what were peaker levels, called 600 all the way down to something with a four handle in front of it, 450 thereabouts. And then you also had the base rates coming down. So what's essentially happened is that the market for senior unitranches has started to kind of normalize out, and the return profile for a unitranche deal, which had previously been sitting on top of sub debt, is now starting to, create a gap between the senior cash flow / unitranche deal and your subordination, and then for that matter, also the equity below it. And so if you were sitting there from kind of an investor point of view, it was very attractive to just get into the unitranche paper because your return was effectively sitting on top of the sub debt and not that far away from the IRR on the sponsor might be getting. And so now, and I think it's good, is that the capital stack is somewhat kind of rearranging itself to be back to called a proper return profile between the various categories, which leads to an opportunity for sub debt to an extent to kind of play a bit of a role in the marketplace. And so I know, Lucas, we've been seeing a little bit of that.
Yeah, I think that's exactly right. And part of that then puts that pressure on junior lenders to compete and get creative. And that's where you saw in our private credit snapshot that we appreciate you publishing so frequently, that junior debt capital, cost of capital come in just a little bit. I think that could continue should rates drop further. Just to stay competitive, junior capital is going to have to think about ways that they can compete. Because the demand is there and the supply is there, but oftentimes it's a little bit almost like a valuation gap difference between the two. A lot of over the last couple of years with rates being so high, a lot of borrowers have looked to junior capital and non-cash pay instruments as a way to address either liquidity or fixed charge ratios or perhaps leverage issues. And it's been popular, but difficult to find that middle ground between the right cost of capital and the need to address something in the capital structure. So, should we see that rate environment change over the course of the next year? I think we could see quite a few more junior capital deals.
Interesting. It'll be good to look out for sure. Another thing I'm wondering about next year is I think early December, it was the leverage lending guidelines were withdrawn. And I'm just wondering how that's going to affect the competition that we've seen between banks and direct lenders going forward.
Yeah, I mean, the quick answer to this is that if there's more players in the marketplace, it could lead to additional supply of capital and compression in spreads. But will that happen right away? Lucas and I were talking about this earlier. It's not going to happen. And Lucas, maybe you want to comment on that a little bit more.
Yeah, I think private credit has done such a great job growing its market over the last 15 years to 3 trillion in AUM at this rate. And they're getting to the point where they have some pretty good defenses set up should more banks look to enter the market. I think such a key of the private credit market is also that you're driven off relationship lending. And all of these private credit lenders have built really strong relationships with sponsors and borrowers that I don't think it'll be the appeal of a little bit lower cost of capital on day one relative to the relationships and the certainty of close, the flexibility that private credit has, that it'll just suddenly open the floodgates for banks to enter the market.
I think the seamlessness to execute a deal that the direct lending community brings is a real key attribute that I think creates a separation in the marketplace.
Definitely. It's a strong differentiator for sure, especially when there's uncertainty and, in the need for capital. Well, this has been very helpful, guys. I really enjoyed sitting down with you both and hearing what you had to say. Is there anything else for 2026 you think we should have on our radars here?
I would just say that I think that going back to our opening, I think that the private markets are prime location in terms of where we're going to see a lot of activity this year, and whether that be through additional refinancings or the like. But I do feel that the M&A markets are on their return. There's evidence of that through the data that we see. And I think what also excites me is just the health of the private markets today. Seeing the robustness in the growth that's coming through. consistently is something that I think excites me about the market.
Great.
I thought Brian was going to guarantee a Mets title for next year, but I guess not.
I don't know if I would be able to do that, but if me setting the record that I would like them to win a title, that would be wonderful.
The the other thing that I do have my eye on, and we talked about it in a little bit in some of the releases that we've put out and in our data, there's also a segment at the left tail, the underperformers, that stress company that maybe has already gone through an amend and extend, that's a little bit older in a sponsor's fund. How are those companies going to get addressed? Does the lender take it over? We've seen more of that trend. I'd be curious to see if that continues headed into next year. Or do sponsors look to further amend and extend? Do they believe in a turnaround story for some of those businesses, even though they might be a little bit long in the tooth? So I think there's a really strong segment of the market with a lot of rising multiples. I'm also kind of curious to see what happens, albeit a smaller portion of the market with the underperformers, and if sponsors are able to effectuate some exits for some of the more aged businesses.
Yeah, there's a lot to keep on the lookout for. Well, great. This has been so great. Thank you both so much for your time. I think that's all that we have to go over today. And I really appreciate you being here with me.
Absolutely. Thanks so much. It was great speaking with you, Krista.
Yeah, thanks for having us. We really enjoyed it.
Sure. Thank you.
This podcast should not be copied, distributed, or reproduced in whole or in part. Neither LevFin Insights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. LevFin Insights is not providing investment, legal, accounting, or tax advice. LevFin Insights is not providing research or making any recommendations, nor is LevFin Insights offering or soliciting any transaction with respect to the purchase or sale of any security that the listener may hold.